Good afternoon and welcome back. For those of you that are just joining, my name is Nate Kaufman and I serve as an economist, vice president, and Omaha branch executive with the Federal Reserve Bank of Kansas City. It's my privilege to be host for this year's Agricultural Symposium, which is focused on the roots of agricultural productivity growth. I hope this afternoon's sessions have been informative for you, and I would encourage you all to continue to share your thoughts, questions, and comments with us throughout the program. I'm pleased at this point to introduce Kansas City Fed President Esther George, and Esther is joining us today to share her views on the U.S. economy, but she also has direct connections to agriculture. We had shown a video at the beginning of today's program that some of you may have not been able to tune in for, and we wanted to take just a moment to show that video before I introduce Esther George in just a moment. So we'll turn to that video next.
Hello, I'm Esther George, President of the Federal Reserve Bank of Kansas City. I'm pleased to welcome you to our annual Agricultural Symposium and to the family farm in Northwest Missouri, where I grew up. Agriculture has changed a great deal over the decades on this farm and across the globe. It remains, however, a key sector of the U.S. economy and a critical component of the 10th Federal Reserve District's economy. Because of our region's strong connection to agriculture, the Kansas City Fed remains committed to a deep understanding of agriculture and ag-related businesses. We conduct research and industry surveys, and importantly, we gain insight from our engagement with those connected to agriculture. This approach brings perspective on current issues affecting the sector, as well as emerging issues and trends. Over time, science and technology have significantly changed agriculture. Understanding the impact of those changes for the U.S. economy and the world is important to policymakers. This symposium is one of the Kansas City Fed's flagship programs. It's an opportunity to discuss topics that not only matter today, but that also have far-reaching influence on global agriculture and consumers in the future. This family farm is a reminder of the roots of U.S. agriculture, and our focus today will be both its past and its future. Thank you for joining us for this year's symposium, The Roots of Agricultural Productivity Growth.
As you've just seen in this video, agriculture has always been an industry that's been important to the Federal Reserve Bank of Kansas City, and it's one of the reasons that we host a program like this focused on agriculture, and specifically this program on agricultural productivity growth. Those of you familiar, though, with the Kansas City Fed may know that we're more broadly responsible for conducting monetary policy, providing financial services to depository institutions and the U.S. Treasury, and supervising nearly 1,000 banking organizations within the 10th Federal Reserve District, which is a region, a 7-state region that includes western Missouri, Kansas, Nebraska, Oklahoma, Colorado, Wyoming, and northern New Mexico. It's my pleasure now to introduce our bank president, Esther George, and as our region's representative on the Federal Open Market Committee in Washington, Esther participates in monetary policy deliberations and provides a perspective based on 3 decades of experience as a bank supervisor. Her policy views are informed by regular contacts with the region's business leaders, workers, financial institutions, and community leaders. Esther also leads the development of the Fed Now service, which will provide financial institutions with the ability to settle payments in real time, 24 hours a day, 7 days a week. In addition, she hosts the annual Jackson Hole Economics Policy Symposium in Wyoming, which brings together international central bankers, researchers, and policymakers to discuss issues affecting the global economy. Esther, we're glad to have you with us this afternoon. I appreciate you joining, and I will turn it over to you.
Thank you, Nate, very much, and thanks to all of you for participating in this year's program. We're now in our 11th year of this symposium, which offers an opportunity for academics, policymakers, lenders, and practitioners to gather and discuss important topics related to agricultural economics. We're proud to sponsor this look at a sector that is so vital to our region, to our nation, and the global economy, and to engage in you in this virtual format this year. Our theme, as Nate said, focuses on agricultural productivity growth. Producers and consumers of agricultural products alike benefit from productivity growth, and it has particular relevance now as strong increases in demand for ag products coincide with a run-up in crop prices. Over the long run, productivity growth is a key determinant in whether increased demand will be met by higher supply or if prices will have to rise to dampen the strength of demand. The importance of productivity growth extends well beyond agriculture, of course. It plays an essential role in the long-run pace of economic growth, as well as the living standards and incomes of households. Productivity growth also lies at the intersection of demand growth and price inflation, a relationship that is attracting quite a bit of attention these days. So in my remarks this afternoon, I'll talk about the role of productivity growth as a consideration for the nation's economic outlook and consequently the outlook for monetary policy. Since the pandemic upended the global economy a little over a year ago, we've made considerable progress along the path to economic recovery. By many measures, the gaps that opened up in early 2020 have narrowed. Real GDP, the broadest measure of our nation's economic output, increased at a robust 6.5% annual rate in the first quarter and is likely going to surpass its pre-pandemic level this quarter. The unemployment rate at just over 6% in April has improved considerably from its nearly 15% peak a year ago. That progress alone is reason to be optimistic. Even so, we remain more than 8 million jobs shy relative to pre-pandemic levels. While this shortfall partly reflects the still elevated unemployment rate, another factor has been a decline in labor force participation, with many potential workers sitting on the sidelines. As we look ahead, I anticipate strong employment growth in coming months, particularly in those contact-intensive industries such as hospitality and live entertainment, where the rebound in jobs has so far been incomplete. The outlook is also supported by an extraordinary amount of policy stimulus, both fiscal and monetary. Fiscal transfers have led to a considerable improvement in household balance sheets, with an accumulation of savings far in excess of normal levels. In fact, the outlook is so strong that the discussion has quickly shifted from demand shortfalls to supply constraints. Engaging the economy's progress, I see three big and somewhat sequential questions that policymakers will grapple with over coming months. The first is how actively will consumers spend down the excess savings that many households accumulated during the pandemic? The second is, will limited supply and bottlenecks constrain this urge to spend, or will production, possibly supported by productivity growth, be able to keep up with the rush in demand? And third, if strong demand runs up against production constraints, will the effect be a temporary increase in prices and inflation, or a more persistent change in price-setting behavior of businesses? Starting with the outlook for household spending, let me tackle that first question. Healthy balance sheets suggest that households have the capacity to spend. If and how quickly households spend down their excess savings will likely be an important determinant of the pace of growth over the next few years. While households could draw down their savings quickly, several factors suggest to me that people may want to hang on to at least a portion of that accumulated savings. Households are now painfully aware of new economic risks that might not have been a consideration a little over a year ago. With this recent experience of an economic shutdown, they may wish to keep higher amounts of liquid assets relative to the past. Also, since the fiscal transfers have largely been temporary, consumers might not want to materially change their spending decisions in response to only a short-lived increase in income. The second question, will supply constraints impede growth? We're certainly hearing anecdotal evidence to this effect, with labor, materials, and transportation services reported as being in short supply. For labor, this shortage reflects the still depressed level of labor force participation that I mentioned earlier. How quickly supply can grow to meet higher demand will likely, at least in part, depend on the factors that are behind that decline in labor force participation. Some of the fall is likely due to the pandemic, either through restrictions on activity, lack of childcare, enhanced unemployment benefits, or even fear of contagion. As the pandemic fades and time passes, these factors will reverse and labor constraints should ease. However, it's also possible that some of the decline in participation reflects a growing detachment from work for some, especially after the disruptions of the past year. This might be particularly true for workers that were near retirement. In this case, it will likely take a period of strong growth to draw these workers back in. With respect to the widespread materials and transportation shortages, some may resolve during the remainder of the year, but others are likely to persist beyond that. For example, the shift in demand from services to goods during the pandemic has led to a surge in imports, backing up traffic at U.S. ports. The resulting longer shipping times have led to a global shortage of intermodal containers that many in the ag industry have likely experienced. A shift in consumption patterns back to services may help alleviate these delays, but it's not yet clear when that might occur. For manufacturers, surging demand for commodity computer chips has run up against global capacity constraints, which require long lead times to expand. Productivity growth has the potential to play a role in meeting any incipient rush in demand. By allowing higher output with the same inputs, productivity can loosen the capacity and labor constraints that could stifle demand and weigh on economic growth. But predicting the evolution of productivity can be difficult. Measured by output per hour of work, productivity jumped during the pandemic, averaging close to 4% at an annual rate over the past year, more than triple the average pace over the last decade. However, much of this acceleration seems likely to reverse as restaurants reopen and hotels return to full capacity, given their relatively low measured productivity. But it's also possible that certain adaptations made during the pandemic, as well as behavioral changes on the part of consumers, could lead to a persistent increase in worker productivity. For example, over the past year, restaurants saw their customers shift toward curbside pickup or home delivery options. By adapting to this shift, restaurants were able to produce a similar product with less labor input. Similarly, the pandemic has led organizations to rethink the role of business travel in their operations. Travel, of course, is an expensive input for many businesses, and a shift toward far cheaper digital interactions could lead to a significant cost savings and increased productivity. On the other hand, you might argue that hosting a conference like this one on Zoom is a poor substitute for in-person engagement and can perhaps even depress productivity. So all of that is to say that a lot remains to be sorted out regarding the pandemic's effect on productivity. More generally, tight labor markets often incentivize productivity-enhancing innovation. And we see this today at retail stores, where self-checkout has become increasingly common. Let me turn to the third question, which is, how will the dynamics of a strong economy and supply constraints affect inflation? Inflation over the 12 months ending in April, as measured by the CPI, increased to 4.2%. And that's the fastest pace in over a decade, and of course up considerably from the 1.4% pace recorded at the start of the year. What the current pace of inflation means for the inflation outlook in the medium term is less than clear right now. Many factors that have boosted current inflation do seem likely to fade over time. For example, the average price of a gallon of gasoline fell to $1.87 last April as demand fell sharply and inventories accumulated rapidly. Remarkably, these factors actually pushed the spot price of oil below zero for a moment last year. This April, as demand has recovered with a reopening economy, The average price per gallon hit $2.96, an almost 60% increase from a year earlier, but about equal to the average price over the previous 10 years. This normalization in the price of gasoline contributed almost a percentage point to the overall rate of inflation in April. Gasoline, of course, is not the only price bouncing back as the economy reopens. Some services that suffered large price declines early in the pandemic, things like air travel and hotel accommodations, saw prices jump in April, even as they remain considerably below their pre-pandemic levels. As these sectors recover, there is certainly scope for further strong increases, although I would expect as these prices recover, the pace of increase will slow. A normalization of prices depressed by the pandemic doesn't tell the whole story, though. Other sectors have seen prices jump far above pre-pandemic levels as supply constraints have developed against a backdrop of robust demand. This is particularly true for automobiles, where production disruptions have contributed to higher, newer car prices, with even larger spillovers to used car and rental car prices. In fact, as many recent travelers have experienced, rental car prices have increased more than 80% over the last year in the CPI data. Those kinds of bottlenecks, though, seem likely to clear over time and prices to stabilize. Expecting these price pressures to ease, however, does not ignore the potential for more persistent inflation pressures. Over the long term, the outlook for inflation is influenced by demand that is sufficiently strong across a wide range of goods and services that it pushes the overall economy up against its productive capacity. In the near term, it can be difficult to distinguish between a string of seemingly idiosyncratic bottlenecks and a broader-based lack of capacity. In the end, the persistence of any step up in inflation will ultimately depend on the pricing behavior of firms and workers, which in turn will be importantly affected by expectations for future inflation. Measures of inflation expectations, both from surveys and financial markets, have moved up as the economy has reopened and strong fiscal stimulus has boosted growth. These and other indicators of pricing behavior will provide important signals about the longer-run trajectory for inflation. Prior to the pandemic, the economy had experienced a long period during which inflation pressures remained muted, even as the economy appeared to be running near capacity. The apparent lesson from this period was that the inflation process had changed relative to earlier decades, a shift that the Federal Open Market Committee acknowledged in the adoption of its new monetary policy framework last year. Although providing the context for the revised framework, the cause of that shift in inflation dynamic remains relatively obscure. As such, an overarching takeaway from this period might be that the inflation process can change and that changes can be relatively persistent. While it's clear that several temporary factors are boosting inflation now, I'm not inclined to dismiss today's pricing signals or to be overly reliant on historical relationships and dynamics in judging the outlook for inflation. The past few decades saw inflation play a relatively minor role in the day-to-day decision-making of businesses and consumers. Maintaining this state of affairs as we seek to achieve our objectives for maximum employment and price stability will be important. Let me close with some thoughts on the outlook for monetary policy. As the pace and strength of the recovery unfolds, monetary policy settings remain highly accommodative and will remain so for some time in line with the FOMC's forward guidance. The committee has stated that it expects to keep the policy rate near zero until the labor market has reached levels consistent with maximum employment and inflation has risen to 2% and is on track to moderately exceed 2% for some time. The FOMC also expects to maintain its purchases of treasuries and mortgage-backed securities until substantial further progress has been made toward these employment and inflation goals. Judging the appropriate timing for policy adjustments is always challenging. The economy is an incredibly complex set of relationships, many of which have been disrupted by the pandemic with uncertain long-term consequences. This is true for how we consume, how we produce, and how we work. As the economy works its way toward a new equilibrium, policymakers will be well served to take a flexible approach to monetary policy decisions, in my view. In this regard, the Federal Reserve's revised framework for monetary policy, adopted last August, provides just that, a framework rather than a rule. The FOMC has in the past avoided strict adherence to monetary policy rules, so it's unsurprising that this new framework is not a precise prescription for policy action, even as it repositions the Federal Reserve's approach to achieving its congressional mandates for employment and inflation. The structure of our economy changes over time, and it will be important to adapt to new circumstances rather than adhere to a rigid formulation of policy reactions. With a tremendous amount of fiscal stimulus flowing through the economy, the landscape could unfold quite differently than the one that shaped the thinking around the revised monetary policy framework. That suggests remaining nimble and attentive to these dynamics will be important as we seek to achieve our policy objectives in the context of sustainable economic growth and the well-being of the American public. Thank you very much.
Well, thank you, Esther. I appreciate you getting us started here and joining for this afternoon. We'll now turn to the audience for questions, and I would invite everyone to please submit a question using your page there if you go to the questions and comments link. And Esther, I'll get us started with a question and go from there and take as many questions as we have time for this afternoon. You've had a number of years of experience with the Kansas City Fed, and a lot of people will know that you may have started your career as a bank examiner, and so you've seen things change over the course of the decades and the implications of some of the things that you've discussed already, and maybe one of those coming back to the inflation aspect of things. I guess I'm curious, what sorts of considerations do you think would be important as it relates to inflation, and what sorts of long-term risks do you think the committee would want to be most aware of when considering, how it's assessing any future policy decisions alongside some of those pressures?
So it's probably one of the most important things that we're watching today. So as you see inflation come in at the levels it did last month, Nate, you hear a lot of people invoke looking back to the period of the 60s and 70s and what similarities there are. And as with many things, there can be similarities and there are always differences that policymakers have to apply judgments to. So I think the way I'm looking at it right now is to say we certainly see that people have a lot of money. There's a lot of excess savings. I expect that having gone through this period of restrictions on our ability to carry out some of the spending that we normally would have done, there will be some pent-up demand. And so what you will want to see is not the near-term inflation outlook, but to really judge how much capacity constraint here will be persistent enough that it begins to change the dynamic of how people think about inflation and what they expect in the future. And so a good example right now, I think, is watching, for example, housing and the housing prices, how those have gone up so dramatically. One of the questions is, will that cause people to sit back and say, I think I will wait and let those prices adjust? Or as the dynamic we saw 50 years ago, will people say, I'll buy now because I think they will go even higher? So I think it will take us a while to see how this economy sorts out, what its new normal looks like, and yet being very mindful that you could get some of those pricing behaviors to kick in. So it's a very important area for the committee. And because we are given a mandate to maintain price stability, it certainly will be in the forefront of my colleagues and my considerations.
Esther, you mentioned a little bit, you talked about the monetary policy response and obviously remaining highly accommodative in the face of what we've experienced for the past year and a half. And of course, we also know that there's been a substantial fiscal policy stimulus in addition to that on the monetary policy side. So our first question here from the audience asks, how do you view the impact of growing U.S. deficits and debt as you look long-term at the U.S. economy? I know that's probably a popular question that people might be interested in.
Yeah, I think this is a question all of us are paying attention to, because I think even prior to the pandemic, there were questions about the level of sustainable debt, given that we were looking at demographic changes in the country where people would begin to rely more on entitlements, health care during a period of aging in this country. And so then when the pandemic hits, I think Congress made some very necessary responses. But that, of course, has added to fiscal debt. So those issues are of particular challenge to those that have to set fiscal policy. And those of us that are focused on monetary policy know to keep our attention squarely on the pieces that we are asked to pay attention to. But I think the question is always, people understand that those fiscal debt levels can come with higher price tags. It can come with, in a rising rate environment, more interest expense. So it's understandable why people are paying a lot of attention to that as we look to the future. And again, other policymakers, I think, will have that squarely in their sights and on their plate.
Thanks, Esther. Our next question kind of gets at a little bit some of the discussion that we had earlier in today's program and relates to maybe what we've often talked about as the unevenness of the recovery that we've experienced over the past year or so, and recognizing that even as some industries have maybe recovered quite well, there have been others that have maybe trailed a little bit more in that recovery. And the question asks if you could comment a little bit on how the FOMC addresses some of those discrepancies and disparities and what sorts of things are important when considering monetary policy being a relatively blunt tool. How does that conversation play out amongst you and your peers? So it's a very good question, because that's exactly what we've seen both during the pandemic, and I think you see it during the recovery as well, and that is a great deal of unevenness. And it happens in several ways. First of all, obviously, unevenness during the pandemic when we saw services take a hit. So our ability to get out and go to restaurants, to travel was restricted. And so that meant certain sectors of our economy essentially shut down. While others, and again, thanks to our ability to order and pay for things online, we actually saw some other parts, the good sectors of the economy, really take off. We were able to buy bicycles. There was more demand for electronics and other things that did quite well during that period. And so you got unevenness in the economic data from that. We saw that in the labor market as well. Again, if you were in one of those sectors, you were disproportionately affected by the unemployment hit compared to those that were able, again, to work from home and use technology to continue to carry out their work. So that kind of unevenness will take a while to work its way, I think, through the economy. And so the Federal Reserve has to think about when we'll begin to see broad-based recovery and broad-based response. That's why I said early in my remarks, even as we see that unemployment rate dropping, a very good sign. We see GDP growing. We know there are still more than 8 million people that are on unemployment. And so that gives us a sign that the economy is not yet fully healed. So the FOMC has communicated that it will intend to continue to provide support to the economy until it has reached sustainable growth levels. And that has a lot of moving parts right now, but that's what we'll be watching for. Our next question, Esther, gets at the prices, and it's kind of sticking to this topic of inflation, but also connected to monetary policy and how businesses and individuals go about making decisions. So we've talked about the rapid increase in crop prices in this program, obviously the focus on productivity growth, what that means long term. We've heard the anecdotes, for example, about certain prices for other raw materials, and you commented on this. You mentioned housing. This question asks, the steel industry is positioned to keep increasing prices due to tariffs and restrictions in supply. In the long run, though, neither of those causes of higher prices should be a factor. But in the short term, people and businesses are making inefficient decisions. So how is the Fed looking at this in the big picture, and what are some of the responses?
Yeah. So I think the question used the characterization of short term, and I think it's important there because when the Federal Reserve looks at its ability to achieve maximum employment and price stability, it looks at those really in the medium term, but also in the long run. The Federal Reserve's mandate really is a long run focus. And that's why it's difficult right now as we see those price pressures for the public to look at that, and particularly those that feel the pain of that, to understand, is there something that can be done? Right now, in my view, we just have to watch and see whether those constraints begin to ease and to what extent they begin to feed through. And it's too soon to know that. I am mindful, though, for those kinds of inputs, as you know, Nate, where we try to separate headline inflation from core. In other words, looking at things like how commodity prices might feed through to food or how energy prices. Those high prices affect real people, and we know that. People that are spending money for groceries, for gasoline to get to work, those are not prices that they have many other choices for. And so I think it's just important to remember that as we think about our policy decisions, we think about how those are feeding into the long run, that we communicate very clearly about what we see in the data and how we expect that to unfold.
You offered some comments there about the distinction or the delineation between the short term and the long term. And we know that as we talk about the position of monetary policy, you know, some of those tools maybe even look different now than what they might have a couple of decades ago, and coming out of the last financial crisis and recession and the purchase of the asset purchase program that would have been a different kind of tool. So this next question asks if you could offer any comments about some of those asset purchases and the Fed specifically targeting some of those longer term interest rates, and what your thoughts are on those potential adjustments.
So the Federal Reserve has continued to think of the federal funds rate, the overnight short-term rate, as its primary policy tool. So when we talk about interest rates being moved down to near zero, as we did a year ago, March, that still remains, I think, for the FOMC, a primary instrument of monetary policy. But as you know, the Federal Reserve's balance sheet, starting with the 2008 and 2009 downturn, also became a significant tool of policy. And it has been used again in this circumstance to respond. Initially, because we saw panic in the Treasury markets and markets were not functioning well, which of course is critical to the economy being able to operate, to individuals being able to access credit. So the Federal Reserve's purchases certainly were designed initially to make sure that those markets could function. And you began to see, after a period of a few weeks, that markets did begin to stabilize. Those purchases today have continued, and the committee has noted they're continuing because of their effect on longer-term interest rates, those interest rates that are important, for example, for mortgage rates, as a way to stimulate the economy. And of course, today, the Federal Reserve's balance sheet has grown considerably higher than it was during the last downturn. We are now getting close to $8 trillion on that balance sheet. And there will come a point at which the committee will need to talk about how that instrument is working relative to our interest rate policy. The most recent minutes of the FOMC mentioned that to the extent the economy continues to heal and jobs come back, that there will come a time that talking about the reduction of those purchases is going to be important.
That's a good segue into our next question here, Esther. It's wanting maybe if you can elaborate a bit more on the asset purchase program. And, a feature of the last recession was to begin purchasing, for example, both long-term treasuries and mortgage-backed securities. But alongside some of your comments, for example, about the increase in housing prices, and as we think about that market in particular, this question asks, when it comes time to pare back the Fed's overall asset purchase program, should those MBS purchases be slowed more rapidly than treasuries? Do you have any thoughts on that?
So that's a discussion that the committee has not had yet, and of course will be part of any conversation in thinking about the mix of assets and how those reductions take place. So it's really premature for me to speculate on that. I understand the question, though, which is to say, because we're an influence in those mortgage markets, and given that we see the housing market in particular experiencing a lot of heating up, it's a fair question to ask, to what extent do those asset purchases differ, than the Treasury purchases? So I think that will have to be part of the discussion as we get into that. And really think about what effect our purchases are having on broader financial markets as we begin to think about that.
Shifting gears just a second here into a question that's maybe asking for your thoughts on international developments and how those conversations play out. Maybe if you have any specific comments on China and how much China enters into the policy discussion. And then this question also asking if you have any thoughts on the coming potential dramatic demographic changes in China in the coming decades, just given its significance in the economy and its growing influence in the world.
Yeah, I think it's a great question because even as my comments today have focused on the domestic economy and the U.S., there's no question that any forecast for an outlook for the U.S. economy does factor in how the rest of the world is faring. And I think that, too, begins to create more complications in really understanding what is a new equilibrium for our economy when we see the rest of the world also dealing with some of the same issues that I've talked about, which is economies that are healing. We're in varying places. Back to the question about unevenness, we certainly see unevenness in the global economy in terms of which ones have been able to address the virus most directly, which ones may be lagging. That, of course, will affect their ability to both get back online with trade and consumption in their own markets. So every aspect of the global economy, I think, is critical right now. That's not just China. That is looking at Europe. It's looking at the UK. It's looking at the Northern Hemisphere to really understand how has the pandemic been addressed and what then are the prospects for foreign growth. And that's really where I'm focusing, is really broadly. The issue about demographics is also one that I think we have to look at broadly. This is an issue for advanced economies around the world, as well as others, which is your demographics are going to be an important story in understanding how your economy is going to unfold. So it's a great question and one that policymakers certainly have to be mindful of right now.
Esther, you offered some comments during your remarks about the nature of the labor market and recognizing, obviously in the initial months of the pandemic, some of the challenges, and that there has been some recovery, but some of those challenges remain. We, of course, hear a lot of ongoing anecdotes about labor shortages, but this all amid an environment that has been highly uncertain. And so this next question is if you have any thoughts about any signs of structural changes in the job market that maybe has played out alongside of the pandemic over the past year, and maybe connected to that, any policies that specifically may tie into that you think would be worth mentioning?
So I think this is going to be one of the really interesting things to watch unfold when we try to come to terms with what is a new normal for the economy. And by that, I mean, we've all seen, for example, well before the pandemic, changes in the retail sector of the economy. Those most certainly have been accelerated by virtue of what we've just been through in terms of people being far more willing to use online shopping, to pay for things online. And those are things that I don't expect will necessarily reverse. As it relates to the labor market, of course, depending on where you were situated in that labor market, we could see changes there too, that if they do reverse, could take some time. And again, by that, I'm thinking about things like business travel and how cities and municipalities would have businesses built around certain aspects of that economy. If that is slower to come back, if that is more permanently altered, it affects things ranging from real estate markets to the nature of jobs. So that's, I think, a part of watching this recovery, both near term, medium term, and longer term, that's going to be really essential for policymakers to understand what does it mean, which of these things really are reshaping the U.S. economy in ways that will alter either relationships we understood, where growth will come from, and where, as we look at the workforce, we could see shifts in that as well. So it's one of the key questions, I think, not only as I addressed in my comments, but I think that we're going to have to continue to watch over the next couple of years before we get a really clear picture about what the economy will look like in its more steady state.
Esther, in your comments too, you talked a little bit about some of the policies or things that were possibly used to mitigate the stress associated with the pandemic. There's time for a couple more questions here, and I want to go maybe a bit more specifically to agriculture. We've been talking about productivity, but recognizing that we'll also have more conversation tomorrow, for example, about supply chains and how some of those disruptions have maybe played out and other factors that might affect either productivity or production in general in agriculture. So this question asks if you have any comments about what is the Fed doing on a policy front then to encourage businesses, especially farmers, to be prepared for possible disasters or disruptions in the future when they're making some of their decisions?
It's a great question because I think if we were to make a list of lessons learned from this experience, it's one of the things that I think I hear from many of our business contacts, and frankly, people in our communities more generally, is the ability to anticipate disruption and shocks, whether that's personally, and I think about that in terms of whether people will hang on to more savings, have a better cushion there in the future in the event they lose a job, have an illness that affects them. But it's also true for businesses. And Nate, you know, we hear this from our contacts, both in the ag sector, we hear it more broadly, which is when we have moved to the ability to do just-in-time inventories, for example, understanding what it means, whether it's single-source suppliers, whether it means diversifying that in some cases, and I think many businesses had, but if you lose a particular source of input for your product, or an outlet for the product that you make, it can have broad consequences to your revenues and to the viability of your business. So I think all of us will be thinking about what does it mean to build in resilience to our businesses? How do we think about that? Certainly in agriculture, but I think broadly across this economy, I hear people talking about that today.
So Esther, my last question for you here is, for those that were able to see the video beforehand, may not have known that you spent some time on the farm, and I won't ask a question about all of the decisions that you've needed to make that connect to the farm over the years, and which is in and of itself, I think, quite rare of a policymaker with the Federal Reserve. So our last question here for the day is how does that experience on the farm, or how has that experience impacted your work as a policymaker and with the Fed?
Yeah, it's a great question. I guess it's really a privilege that I serve a region where agriculture is so prominent. That experience really does apply firsthand when you sit down and talk to people who contribute so importantly to the globe, certainly to our nation, certainly to the region I have. We know that over the last 50 plus years, we have seen scale become important. We have seen technology. I see that on my own farm. What used to take a week or more to plant a small farm can now be done in a matter of hours with technology. The data I have at my fingertips to understand everything from the quality of the soil to what kind of production we're going to get is much more readily available in that sense. And having to think about the issues of price and productivity are also important there. So it's a good backdrop to have. I always learn from these kinds of programs, Nate, in terms of hearing from people in academia, in people that are producers in this space, and policymakers around the world to understand how this vital sector is changing so dramatically. So, those roots have been helpful to me, and I look forward to the rest of this conference to learn more about how that's changing.
Well, thank you, Esther. I appreciate you offering some time this afternoon and sharing your thoughts on a broad perspective as it relates to the U.S. economy. Many of those things that you've talked about will be important for us to understand in agriculture and even more specifically in this region. Appreciate everybody else joining for this afternoon and with the program today, and also for the questions. A lot of good questions. We look forward to everyone joining again tomorrow for the remaining two sessions. For those coming back tomorrow, our program will pick up at 8:30 in the morning Central Time, and that will be a keynote address from Earthrin Cousin. Earthrin has more than 30 years of national and international nonprofit, government, and corporate leadership experience focused on agriculture, food security, and nutrition. Just as a housekeeping item, to connect to the webcast tomorrow, please be sure to use the Day 2 link from your confirmation email. So Esther, thank you again for joining us. Participants and attendees, I appreciate you also joining. We look forward to connecting with you again tomorrow and continuing the discussion on agricultural productivity. We're adjourned for today.
Thank you, Nate. Good day.